Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Well, hello again, and welcome to our little get-together called a radio show. Later, it becomes a podcast. I'm Don McDonald, along with Mr. Thomas Seacock, here to help you muddle through the massively confusing, frustrating, bewildering, often horribly misleading world of managing your money.
The mysteries of managing your money. Yeah, something like that, right? There's a lot of misinformation. There's a lot of
it's just
junk. There's a lot of stuff.
There's always junk. Does it surprise you how much junk there is constantly floating around out there, getting people's attention? Oh, I must buy the stock of AMC Theaters because before the pandemic they were doing so well. Oh, wait, no, they weren't.
No, they were not.
You know, the pandemic nearly killed them, and they survived it thanks to Reddit, but they were able to float a new public offering. But you guys are just, you guys, and that's generic, they're you gals too, you peoples, you are just terrible at investing sometimes. You're just really bad at it. And by the way, you self-proclaimed financial advisors out there, you're not much better. You'll do anything for a buck. You're Larry, Daryl, and Daryl Financial Advisors, a Bob Newhart reference from many years ago. Anything for a buck.
I like the other one better. Dewey, Cheatham, and Howe. Great firm. Don't go there.
Okay, a year ago.
By the way, you didn't give the phone number yet.
Oh, yeah, I got to give a phone number. You guys want to call us? Do this.
Got a lot of calls the last few weeks, so I'm thinking yes.
Dial. Okay, yeah, the one of you with a rotary phone still, who's locked in the basement.
Saw one on TV the other night.
Who's locked in the basement with your cats and 30 years of old newspapers. You know, you.
This is starting more and more like me, but okay, yeah. I don't have the rotary phone, but close.
You dial 855-935-TALK. The rest of you, push those artificial buttons that are just your screen on your smartphone, 855-935-8255, and then we can help you with your particular pecuniary problem.
Which is why we're here.
Yeah.
We can blather on about all kinds of stuff, but we're here really to answer your questions.
No, we are darn good
no
blatherers,
blather?
too. We are the best of the blatherers.
By the way, if you don't get enough right now, you can hear more blather on at talkingrealmoney.com or wherever your favorite podcasts are heard, pretty much everywhere. Yeah. And we put them up there almost every day. So if Saturday, a couple hours, not enough, I got to have more. Go to the podcast. It's up there. Anytime.
I've got so many questions that people have called in or sent in via Talking Real Money that this weekend I may have bonus episodes of Talking Real Money up there.
The bonus.
The Q&A stuff. So, yeah.
You were saying.
Before you interrupted?
Yeah, once or twice. I'm sorry.
All right.
It felt funny.
Let me go back a bit.
Yeah. Okay.
Just over a year ago, you would have been hard-pressed to find a single financial advisor who suggested or recommended that you put any of this ludicrous cryptocurrency in your investment portfolio. 1% or less.
Now?
Non-existent. Now, 14% of financial advisors are telling their clients they should. Well, actually, I don't know that they're saying they should.
No, they're saying they use or recommend.
Yeah. They're putting crypto into your portfolio. And do you know why they're doing it? Are they doing it because they think this is by far the best investment for my clients? Yes, they should be in it. No,
I think it has something to do with the 49% of advisors saying in the last 6 months clients have asked them about digital money. By the way, I am really proud to say I have yet to have one of our clients come in and say, hey, you really got to get me in that Bitcoin thing or Coinbase or Dogcoin.
Maybe it's because our clients are smart enough to realize we don't pander. We don't do what you want us to do. We do what is the right thing, those things that are the right things to do based on solid academic research and this little crazy thing called common sense. And Bitcoin and Ethereum and Ripple and Dogecoin, none of those pass either the common sense test or the academic research test. They fail miserably on both counts, and yet advisors will put you in it. Why will they put you in it?
I think they're trying to sell something. Even Goldman Sachs says they've crossed the Rubicon in terms of the institutional buy-in, and there's much greater value in the space than there was 3 or 4 years ago.
Yeah, and the Rubicon's about to go into flood stage and drown everybody crossing it, so just beware of that. 855-935-TALK. That's our phone number. Give us a call. We'll talk about the things you do with your dough.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Tell you what, this time I'm going to start with the phone number. 855-935-TALK, T-A-L-K, or 8255. Give us a call. We will help you avoid a problem. Try to find a way to help you get out of a situation that you're not particularly pleased with. Try to help you do better things with your money. Try and help you do less dumb things with your money. Try to help you avoid all the panderers out there, the anything for a buck guys, like my favorite anything for a buck guy out there right now. I think probably leading the pack, ladies and gentlemen, has to be from the heart of Tennessee, Mr. Dave Ramsey.
You just like picking on Dave. I know why you picking on him, because it's good for the podcast. We get a lot more people tune in and say, why are you picking on Dave?
No,
Come
Dave
on.
Dave is anything for a buck boy.
I know.
He really is. I mean, he's associated with Xander Insurance, and man, Xander Insurance is the insurance company out there. Xander they won't just sell you insurance. They'll sell you ID theft insurance now. They got every insurance known to mankind at Xander Insurance. Call Xander Insurance right now and make Dave a buck. Also, he's got his favorite investment advisors with the heart of a teacher, and they'll sell you loaded mutual funds.
Which no one should be. There is absolutely no reason in the world. Anyway, we'll get into that.
Oh, wait, there's more. Conflicts. Wait, there's more. Wait,
yeah.
I'm Dave Ramsey, and I got some friends out there who are going to rip you off, getting you out of your timeshare.
Okay, can you really get out of a timeshare? I got to ask you that.
Some timeshares, yes.
Because you have to find somebody else to buy it from you, right?
It's like a piece of real estate, although you don't own the real estate. You just own the rights to use the real estate for a little while. In essence, you bought to rent. And so one of the problems with these timeshares is the math. When you sit down and actually work the math, even if you go there every year for the next 40 years on vacation.
Don't you want to know how you're going to vacation every year for the next 40 years, Don? Well,
okay,
next 20.
I did the numbers, and one of the better timeshare deals out there is Disney's.
Yeah.
But I was looking at I ran the numbers on one of Disney's resorts here, and it's a nice resort. It's the Grand Floridian, but their timeshare thing, it's what was it per week? It was $3,300 for a week, which is $400 a night, 400 something. Plus, you got your maintenance fees of another $1,200 a year or so. Now you're looking at $500-600 a night. If I buy right, I can get a really nice hotel somewhere for $500 or $600 a night.
Okay, but doesn't the timeshare, one of the appeals is you don't want to stay there, you can go to Hawaii instead, right?
Well, that's one of the benefits of Disney's. Most of the old traditional timeshares, the kind you buy when you get off the plane in Mexico and you run the gauntlet.
The signs are whacking you.
Yeah, they're selling you.
Always love those.
They're selling you a week at a dump. And
I see.
Those are the ones you will never be able to get out of, ever, because they put the sales pitch on you. I mean, they won't let you out of there, because what they do is they take your children and they hide them in the back room, and they go, you want your kid back?
I went through one of those about a decade ago, and they told us, don't worry, it's just going to be one. It was from a reputable, I use air quotes, reputable operator. And we went through about an hour. And then, of course, they have the next person come in. I mean, it was on and on and on. But we're missing the point here. The point was,
that was a good point.
We were talking about very good point. We were talking about the first advisors that trouble us are the pandering type. And there are many that you go in to see. And if you tell them, look, we really have to have this, or I don't like the mutual fund I'm in, they're going to tell you, oh, you're absolutely right. We need to get you into Bitcoin. You're absolutely right. That mutual fund has been underperforming. We've got a better one for you. And that is not good financial advice. But the other one is conflicted advice. And that is where people will send you a certain place because they're getting paid to do so.
Dave Ramsey.
And Dave Ramsey. Now, and Dave, as we all know, got in a lot of trouble, first of all, when he was a financial advisor without being a registered financial advisor.
Yeah, he was getting a piece of the action from the advisors, which were really stockbrokers he recommended, and that is being an advisor solicitor, and you have to be registered with the Securities and Exchange Commission to do that. So what Dave did instead was just charge them an advertising fee to be on his list of recommended advisors, trusted advisors. But he also did this with a lot of other things, like I said, Xander Insurance, and a company out of the Seattle. I think they're out of Washington.
No, I don't know. They're out of Washington.
Well, I don't know. The Attorney General of Washington went after them.
Yes. They've sued them. Yeah. Yes, Timeshare Exit Team.
Yeah.
And then, now normally we don't get our financial advice from Inside Edition because it's really not deep dive into financial. Yeah, I love the bright, but no, I mean, but they just did a piece this week talking about how Timeshare Exit Team told people, look, we will get you out of you will get you out of your timeshare. And Dave Ramsey has endorsed them, saying, Timeshare Exit Team, it's the only people, maybe you should do it. The only people we endorse
timeshare exit strategy
for getting you out of your timeshare because it works.
Yeah. Well, no, it don't work. Sorry.
Yeah. Again, that's why I was asking you, is it easy ever to get out of your timeshare? I don't think it is.
Well, no. Anytime, here, I'll tell you. Well, first, these guys charge between $3,000 and $9,000 up front.
There were several people on the report that said they'd paid $5,000, and the Timeshare Exit Team had told them 100% money back guarantee, which they apparently didn't make the money back guarantee. They didn't get rid of the timeshare. They got stuck, and they said, we were stuck once. Now we feel worse because we got stuck another time by apparently another ripoff. And so they had a whole bunch of people on there. And the reporter asked, if any of you feel like you're taking advantage of, and every single person raised their hand.
You want to get out of your timeshare, I will tell you how to do it.
Oh,
wait,
should we charge?
No.
Should we put up a website?
No.
Okay.
No. Go online and find timeshare resale sites.
So you're going to take it in the shorts.
You are, but instead of taking it in the shorts and spending $5,000.
I see. Just do it one.
I mean, if you have a crappy timeshare, for example, if you bought some of the stuff in Orlando where I live that wasn't Disney or Marriott or Hyatt, you are going to probably lose a lot of money. Now, the interesting thing that I have discovered is that Disney's Vacation Club points actually hold their value really, really well.
Yeah, that's no surprise there, right? Quality place.
It's the name.
Yeah.
But generally, you can pay a small fee or a tiny percentage of what you get to these online timeshare sales groups, which have a real estate. They have to have a licensed real estate broker involved because it is a real estate transaction, and you pay them a fee and they list it and find you a buyer. But remember, like anything else, it's not what you think it's worth. It's what the market thinks it's worth. The markets are reasonably efficient, and if you have a terrible timeshare, you're going to get a very low price.
This is really not a show full of good news for people, is what you're trying to say.
It is. I mean, if you're going to, I can say, honestly, if you're going to go to Disney World or Disneyland or Aluna or Alana or whatever it is in Hawaii, every single year, a Disney Vacation Club might make sense. But boy, you better run the numbers, because you can spend a lot of money on hotels for the kind of money you spend, particularly when you consider you can invest it and keep the principal. 855-935-TALK.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
In addition to taking your phone calls on the show, and that 855-935-TALK number also works anytime. You can call off hours, and we'll take your question and answer it on a future podcast. Or you can send your questions in at talkingrealmoney.com, either in written form or you can record them there. We give you a lot of ways to get your questions answered. And so give us a call at 855-935-TALK or go to talkingrealmoney.com. Now, I need you to pay attention to this next one. You got
enough trouble with the timeshare deal, but okay.
You got to get focused. This is a long one.
Okay.
You right? You ready?
Oh, gosh. Yeah.
I try to take them in a semblance of order. And, okay. Hi, Tom and Don. Well, actually, he said Don and Tom, but since you're taking the question, I thought I'd give you top billing.
Very kind.
I want to provide the exact opposite answer to a few recent questions answered on your podcast. A few questions in recent episodes asked if it makes more sense to delay RMDs until the end of the year to allow for more tax deferral on your gains. Your answer of yes is mostly correct, under the assumption that the money is being taken out and placed into cash equivalents for near-term spending, which is what we say. That's your budget for the year. On the other hand, many folks will be taking RMDs out of their traditional IRA and placing them back into investments within a taxable brokerage. In this case, it's actually more tax efficient to take the money out at the beginning of the year and further take as much out as you can without bumping into the next tax bracket, although this might be difficult to calibrate exactly at the beginning of the year. For a given stock index fund share, while within a tax-deferred vehicle, any dividends and growth will ultimately be taxed as ordinary income. However, once the share is outside of a tax-deferred vehicle, any dividends and growth will be taxed at long-term capital gains. Therefore...
Yeah, okay. All right.
It?
First of all, there's a little bit of a problem here, because if you go back about a paragraph there in terms of the required minimum distribution and gaming it, the number's the number. Has nothing to do with your tax bracket. However much you have to take out of that.
Oh, but what he's saying is take RMD plus if you can get up.
Oh, okay. That's a different, because we're getting kind of confusing. Yeah, he's saying, well, go ahead and move more over, which could be a good strategy. Again, depends on a lot. There's more than just those simple factors.
And
but what he's really saying, or he is saying.
His last paragraph says, I hope this helps add some nuance to your answers and highlights the fact that it's hard to give concrete answers that cover everybody's situation. And this is what we say all the time.
Yeah.
On the radio, we cannot answer include everybody's situation and every possible scenario that might come from various changes to your plan. That's why we offer people free meetings with us for the really complex get down in the dirt.
Well, even not that complex. But anyway, so he's correct. If you take the money out January 2nd and then you invest it and it grows and then you take it out of that post-tax or taxable account, yes, that should be taxed at a lower rate than you would have taken it out of your IRA. That's no argument there. And by the way, now with exchange traded funds, you can invest it in exchange traded funds and have very little taxation while the money's growing in that taxable account due to the way they're structured.
But, this also, though, I mean, if you really want to get into the nitty-gritty of this, what makes even more sense than what he's saying is take it out as much as you can without going into a higher tax bracket and put it in a Roth.
Which would make more sense. And by the way, what really makes sense is what the House of Representatives Ways and Means Committee passed a couple of weeks ago. Secure Act 2.0, I think it is the legislation. And that is going to push back required minimum distributions to age 75. Apparently that measure is going to pass the House. It's bipartisan, unlike anything else in Washington, and it may get through the Senate. Yeah. So if that were to become law, then you can push back those RMDs to age 75. So change things
then,
again.
You know,
who knows?
So then your odds of being dead increase, so you're not going to care.
Well, they do, but that
was
also
a bad
increases,
joke.
Okay, sorry. It opens up the Roth conversion strategy even more, because if you're 63 and you're retiring, or 65, I got a note here from somebody who's just turned 65. He's a client. His name is Mike. He just retired, so happy retirement, Mike. So if that's the case, then you have these 10 or 12 years.
You get shout-out requests on your phone?
All the time. All the time. It's crazy. So anyway, it is complex, but in a general sense, I still would say wait, because the investments are going to continue to grow in that IRA. You take them anyway. We're in the weeds. We're in the deep weeds.
Yeah, I could tell by the length of this that it was going to be a weedy note. 855-935-TALK. Give us a call. We were full up last week.
Tom and Don are talking real money.
Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
You know, it's been weird lately. Oh, by the way, 855-935-TALK is our phone number. It's been weird that you haven't called. It's been really weird lately. Like in the past couple of weeks, I'm starting to grow accustomed to not wearing a mask going places. Because now a lot of places you can go, they say, if you've been vaccinated, you're good, come on in. Particularly in Florida. And today I went someplace and they had the mask sign up. I had to go back out to my car and go, oh, I forgot. I still got to wear masks once in a while. So we're like almost post-COVID, right?
Yeah, we're getting closer to the new normal, Don.
New normal.
We're dealing with the new normal that we all have to settle in for. So, yes, that's true.
Yeah, well, I tell you, things like the new normal, they're like gibberish. It's mumbo jumbo-ish. It's
in our business. It's different this time.
Yeah,
Don.
different
this time.
It's drivel. It's drivel. I love the word drivel.
Yeah, it's a good word, and in this case, it applies. And some of this comes from a recent article at our friends at CNBC, who we advise you not to pay attention to.
Our friends.
Yeah.
Wow, if they're our friends, I can't imagine who our enemies are.
Well, we keep them close. We keep them very close. Because they had an article that said, here are the smart money moves to make now as the economy bounces back. The smart money moves.
The post-COVID smart money moves?
Yeah, this is apparently one of them is keep your mask at bay. Have it ready.
All right.
Ready to go.
I feel bad.
Number 2 is rebuild your emergency savings. Because you may have spent them.
This is under the assumption that I blew all my emergency savings.
Right. And they're talking about
I didn't keep my job or anything like that. Okay.
Right. And that does make that assumption. 3 to 6 months of living expenses in emergency saving fund. And by the way, you could have more if your likelihood of continued employment is low.
Sure.
Right?
Sure.
A lot of baby boomers found out that, well, my likelihood of employment I thought was good, but then they said, you know what, you could probably just leave. We'd be okay without you. And if you, here's another thing to think about, I think, is if you don't have any post-tax investment money, because you could take it from that instead of just having. But okay, that's a bit of a nit. They also talk about paying down debt, which. Again, I don't think it's any great breakthrough.
That's pretty much all the time.
Other than our friend Dave, what was his name again?
Dave Ramsey,
he tells you not to have a mortgage. Yeah, I don't think you should. I think if your mortgage is at like 3% a year, I don't think I'd be paying that.
Do you know what I have to say to that?
Not pay that off.
You know what I have to say to that? Balderdash. I'm looking up all of the synonyms for drivel right now. Balderdash.
That which has been way underused for like the last 100 years.
Know.
So well done there.
I know.
Okay, here's the one I love. Rework your budget for the new normal.
Stuff and nonsense.
Rework your budget for the new normal.
That's another.
Because before you were, I think you were paying for a place to live, right? You occasionally paid for a place. things to eat. You maybe have even had some recreation of some kind. You may have paid for gas.
Yeah.
I'm trying to think of the things.
What is it going to be? What's going
to pay for?
What's the new normal? The
new
normal is if the Democrats get their way, you won't have to pay rent anymore. No, I'm joking. That was a joke.
I was going to check the box. Okay,
that was Tommy Rot. That was poppycock. That was phooey. That was hot air. That was piffle. Okay. That was tripe, bosh, bull, bunk, blah, hogwash, baloney. Do you know what? Oh, you're going to love this one. One of the synonyms for drivel is COCK.
Perfect.
You are full of drivel.
Let's just leave it at that.
I'm just going to call him Tom Drivel.
Tom Drivel. And which can work sometimes because stuff ends up on my chin. Rework your budget for the new normal. Oh, pardon me. So that's a very silly one, I think, because
the new normal.
How different is your life going to be? You're still going to, hopefully
it's
you're going to go to work.
It's the new life paradigm.
Yeah, a new life paradigm. It also talks about recalibrating and revise your financial goals. If you were hammered by 2020, you may have to push retirement out for a couple of years. Yeah, okay, I can see that, I guess.
Sure.
You lost your job, you didn't save any money, you had planned to save money, et cetera, et cetera. But the new normal, really?
Yeah.
So the new normal, which includes cryptocurrency?
I have a strange feeling the new normal is going to look almost exactly like the old normal looked. Except
minus the fact that you got to have the mask in your pants pocket or whatever in your purse.
Only till September.
You think that's it? No.
Well, no, September.
On a plane?
No, plane September. That's when they said no longer on planes.
Really?
Yeah.
Will you wear one on a? Well, you're never going to get on a plane again.
I don't want to ever get
like
on a plane again. I don't like flying.
Kind of got a thing.
No, I like
weird thing about it.
I don't mind flying as long as somebody will pay for the first class ticket. I just hate being in the back of the bus with all the grumpy people.
Oh boy, there are so many things I could say with the grumpy
people are so grumpy back there.
Yeah, because they're jammed into this little tiny 33-inch wide seat with no
33.
room in front of your head.
Aren't you
whatever
generous?
It is.
I mean, on some airlines, it's like 22 now or something. It's like
and they've noticed that people are getting bigger, by the way, not smaller.
You can only fit one buttock in. It's just a single buttock seat. Oh, you wanted the other buttock in? You need to buy another seat.
Oh, God. Oh, man.
We'll be back.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
For your real life and real future, Tom and Don are talking real money.
You know, a new airline's starting up. It's tubular. No, not tubular. Sideways Air. Sideways Air is where you can put 4 people across on either side of the aisle, but all have to
stack them in.
They all have to stand sideways. You have to stand.
So it's single cheek airlines.
Single cheek airline. You know,
cheeky.
Never mind. 855 had another great airline
I think
idea,
it's best to leave that.
I'm not going to go there. 855-935-TALK is our phone number, and we, hooray, have an actual call. Jim, welcome to Talking Real Money.
Hi, Jim.
How you doing? Hi, how's it going, guys?
Good.
What's up?
Good.
Just wanted to get some advice. I'm a recently retired civil service worker under the old CSRS retirement program, so I'm getting a monthly income check.
You're getting a real pension. Woohoo!
Yeah. This is the old days, Jim. Well done.
Thanks. And I also invested in TSP for the last 25 years. So I have approximately a little over 200,000 in my TSP, and right now it's under a L income fund. I had it under L 2020, but at 6 months prior to me retiring, it changed to an income fund. So what I was asking is, I have a family friend who works for Allianz. I don't know if you guys have heard of that company.
Yes, we know them.
Let me just step right in right now. We don't even have to go any farther. Let this person remain a friend. They can be a friend
nothing more
forever, but they cannot be someone with whom you do business, or you will never be a friend with them again once we tell you what a horrible thing this person will have done to you by putting you into an annuity product with Allianz.
Okay.
They would be in favor of taking your TSP.
Yep, and putting it into an annuity.
A product, some sort of annuity product that, guess what, pays your friend a lot of money, and you end up with less.
Yeah,
no reason to do that, especially with a pension.
Probably pays your friend between 7 and 8% of your money. Is this a good enough friend that you would write them a check right now out of your retirement account for $15,000?
No, I don't really. My brother is the one that actually has done a lot of business with him. He basically took both his retirement funds and invested them in this Allianz, because the way the pitch is, supposedly you cannot lose any money if the market goes down.
It's an indexed annuity. It's an indexed annuity.
Okay, but let's go back. Let's just step back. So you're going to get a pension. Are you eligible or not for Social Security?
No, not at this time. I'm like a quarter or two shy of Social Security.
Oh, okay. So you could do a little, which I recommend you do.
Yeah, do a little work to get that.
Yeah, do a little work. So then you're going to have two steady amounts of income coming in. The pitch for an annuity is, I give you the money, you pay me back my money with some sort of growth to it, and it should last my life. It will last my lifetime, right? I'm not sure you're a candidate, even if the annuity product was a good one, which we don't think it is.
It isn't
for you. So again, my take would be, no, you do not need to do that. By the way, the TSP has among the lowest costs in America for investment assets. Very, very, very inexpensive. So I would probably, if you're comfortable, leave it in the TSP, draw that when you have to, let your pension go, do a little bit of work, get your Social Security. Now you got two sources of income. And keep your friendship, as Don said, with your
brother's friendship.
Your brother.
Although if you really want to do your brother a favor, tell him to never invest with this person again and to call us before he does. Because let me tell you, those Allianz indexed annuity products, get this, first year, second year, third year surrender charge.
How much?
10%, which tells
so
you
wrong.
The commission is somewhere around 10%.
Of 200,000.
200,000, so that's a $20,000.
By the way,
check.
You mentioned that I do have some friends I should probably pay $20,000 for being friends for a long period of time, but that's another issue of mine.
Yeah, but
because they've stuck with me for a long period of time. So,
but they did that probably because they liked you. I don't think you have to.
That's a bad joke. No, Jim, that would not be a good idea. We would not recommend that.
Not recommended. Thanks for the call, Jim. We really appreciate it. 855-935-TALK is our phone number, and now it is Jerry's turn. Jerry, welcome to the show.
Thank you for taking my call here. I have a question, kind of a tax issue maybe, but I've got a pension. I'm collecting, my wife and I are collecting our Social Security. I've got about $900,000 into my IRA account, and the past few years I've been taking about $50,000 out and rolling it over to my Roth IRA, which puts me in a higher tax bracket, which makes my Social Security about 80% taxable. I'd like your opinion on that. Is that advisable?
Stop doing
it.
Yeah, that would
stop doing it.
Again, you don't want to move to a higher bracket to do a Roth conversion.
Right.
How are you paying the taxes on the conversion? Where's that money coming from?
Yeah, I pay that out of my pocket at the end of the year.
Okay.
That's
all
good.
right. So you're not taking it out of the retirement account.
Is there an amount? Is there an amount you can take out that would not kick you into a higher bracket? Have you sat down and done the math?
No, I haven't. I've got between my Social Security and my pension, I'm getting about $65,000 a year, and I've been rolling over about $50,000 a year. So that puts me at about a little over $110,000 a year.
Yeah. But, that's not an awful bracket, but part of the problem is you're losing a little bit of Social Security, and you're paying at a higher bracket. How old are you?
I'm 67.
Okay, because it's very likely that you won't face an RMD until 75 if this new Secure Act passes. Is your income likely? It's likely to stay the same though, clear into RMD territory. So,
right.
Again, you might want to sit down with a CPA, with an accountant, and figure out what you can do to keep what the right number is every year.
And that's exactly it. There's software out there now with good financial advisors that can show you how much you'd be able to take out of your IRA, convert to your Roth without moving you to the next tax bracket, and what that would mean over a long period of time and be very precise, not just I'm taking 50, I'm moving it. Get the exact numbers, as Don said, do that correctly so that you're not booted up into that next tax bracket. And yes, there should be some planning there. And by the way, in the type of things he holds in his IRA, because you also may not want to see the IRA grow a tremendous amount by being more in stocks than in fixed income, because that's going to boot you into a higher bracket when you got to start to take it out at 72.
And I'm just looking online. There's a whole bunch of Roth conversion calculators that are very robust.
Yeah.
Schwab has one. Fidelity has one. Bankrate. They all have them. So I would.
And this is the kind of thing we do for people as well,
right.
By the way.
So you can get that free meeting with an advisor too and find out. So yeah, there's a lot of ways to do that. You want to just make sure you're doing the right amount every year. You don't want to do more than you should be. And hurt yourself a little bit along the way, because we want this to be all positive, not negative. 855-935-TALK, 855-935-8255. Once you're past the 65, the earlier you're doing the conversion, when you're past 67 or 70, particularly when the RMD is coming up sooner than later, the benefit to moving into a Roth declines over time. So it's better to do them earlier than later if you can work.
Yeah, and smooth it out. I mean, again, if you're 65 and you still have 7 years under today's laws, then you could still move a substantial amount over before you get to the RMDs into Roth. But again, you don't want to move to a higher bracket. You don't want to make yourself pay tax on the Social Security, and you always want to have cash available to pay the taxes rather than paying. I see a big mistake. People pay it out of their retirement account. That doesn't make sense either. So yeah, there's some real work to be done here. It's not a simple thing, but it can be a very valuable thing over time.
Once again, our phone number is 855-935-TALK. You can call us during the show on Saturdays between noon and 2 Pacific, 3 to 5 Eastern, or call anytime and leave your question. We'll answer it on a future podcast, which means you should listen to our podcast, the Talking Real Money podcast, on your favorite podcast service.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And the number is 855-935-TALK. You know, I just ran the numbers on the conversion, and you're kicking yourself up to the 22% bracket. If you only did 25,000, you would still remain in about the same bracket. So you really got to do these calculations. Important. And that's one of the things. Careful. If you're getting ready to retire, you're trying to determine the Roth strategy, meet with one of our advisors at Vestory. This is the kind of thing that we offer them to you to do for free. No obligation, no sales pitch. Just go to vestory.com, vestory.com, and scroll down to the bottom of the page. Set up an appointment at your convenience. We'll find somebody to help you out. That's vestory.com, vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.